Thank you. Hey, good morning, everyone. Welcome to our second financial reporting update of 2018. This session is intended to take approximately 40 minutes, including questions. And your presenters today are myself, and Vanessa Lee, and my colleague, Brian Crichton. We'll be looking at events since our last update, which took place in March earlier this year. Okay. We're going to start by looking at some of the other revisions to IFRS 102, which were issued last December. And again, although these aren't mandatory until 2019, many companies may find it beneficial to adopt them early. Then, a reminder of the expectations in relation to disclosures within the 2018 interim accounts, as well as taking a look at other IFRSs and amendments that are effective for periods beginning on or after 1st of January 2018. And therefore will be being applied for the first time in the June 2018 interims. And finally, we'll go through a news roundup looking at corporate governance developments, in particular an update on the AIM rules amendments now issued to require more disclosure, although not explicitly in the annual report, around corporate governance. An overview of the FRC issued proposed changes to the UK Corporate Governance Code. A look at the new large company narrative reporting requirements and voluntary corporate governance consultation, an overview of the government's announcement for a review of the FRC, and finally a run-through of the recent FRC's briefings. So to start with, we're going to look at an update on IFRS 102. So as a reminder, the IFRS 102 Triennial Review Amendments, which were issued in December 2017, are effective for periods beginning on or after 1st of January 2019, and a revised copy of the standard incorporating these amendments was issued in March, so if you're already adopting, it's all in one place now. In March, we looked at the principal changes arising from the Triennial Review, along with a few other clarifications, which are shown on the slide. These were the early adoption options, transitional considerations in relation to these amendments as well. In today's webinar, we're going to be looking at some of the other Triennial Review amendments that may have been missed. So, some of these other amendments include taking a look at net debt reconciliation, which is a new reconciliation now required, and cash flow reconciliation, so clarifying what the starting point for calculating operating cash flows under the indirect method is, operating profit, being further clarifications of what is included in this measure, and an amendment to the presentation of profit from disposal of operations. Investments in fellow subsidiaries, so there's a new accounting policy choice in relation to the treatment of an investment in a group entity that is not your subsidiary, JV or associate, and some amendments to the glossary for highlighting some of these key changes. I'm going to take a look at each of these in turn. So to start with, IFRS 102 Triennial Review Amendments introduce a new disclosure requirement for a net debt reconciliation, and this is set out in Section 7, paragraph 22, as you can see on the slide. The glossary has also been amended to define net debt as consisting of the borrowing of an entity together with any related derivatives and obligations under finance leases, less any cash and cash equivalents. This reconciliation is essentially a resurrection of the old IFRS 1 net debt reconciliation that UK GAAP users will be familiar with. It's also important to note that while similar, it does differ from the new IAS 7 disclosure requirement, which only requires a reconciliation in relation to liabilities arising from financing activities. The IFRS 102 amendments require this reconciliation to show changes resulting from the cash flows of the entity, the acquisition and disposal of subsidiaries, new finance leases entered into, other non-cash changes, and the recognition of changes in market value and exchange rate movements. It also makes it clear that when several balances, or parts thereof, from the balance sheet have been combined to form the components of opening and closing net debt, sufficient detail should be shown to enable users to identify these balances. A reconciliation for the comparative period is not required under IFRS 102, which again differs from IAS 7, where just the first period of applying the new requirements is exempt from providing comparative period disclosure. When preparing a cash flow statement under IFRS 102, a company has the choice of either presenting operating cash flows using the direct method, i.e. your actual cash flows, or the indirect method, i.e. a reconciliation to the income statement figures. The current IFRS 102 requires the starting point to be profit or loss, but doesn't actually provide any further guidance on what measure of profit from the income statement should be used. So the triennial review amendments now refer to the starting point as being a measure of profit or loss disclosed in the statement of comprehensive income or separate income statement if presented. And this means that as long as they are disclosed in the income statement, the starting point can be operating profit, profit before tax, or even profit after tax, as long as it's consistent. Now, IFRS 102 doesn't actually require disclosure of operating profit, but where an entity does disclose this is common, the current IFRS 102 states it would be inappropriate to exclude items clearly related to operations, such as inventory write-downs and restructuring and relocation expenses, just because they occur irregularly or infrequently or are unusual in amount. The triennial review amendments expanded this list of examples to also state that it would be inappropriate to exclude profits or losses on the sale of property, plant and equipment, investment property and intangible assets. A further amendment is that the current version of IFRS 102 shows the inclusion of profit from disposal of discontinued operations within operating profit in the appendix to section 5. This appendix shows an example income statement presentation of discontinued operations. The amendments change this treatment and state within the body of the standard itself that profit or loss on the disposal of a discontinued operation shall be excluded from operating profit. And the appendix to section 5 has also been updated to reflect this. Taking a look now at investments in fellow subsidiaries, whilst IFRS 102 allows a company to measure its investment in its subsidiaries, JVs and associates at cost, less impairment, all other investments should be recorded at fair value through profit or loss, unless fair value cannot be reliably measured. This can give rise to the question of how to account for subsidiary 1, in the diagram on the slide, investment in sub 2, within the accounts of sub 1 itself. The sub 2 is only owned 5% by sub 1. It is therefore not a subsidiary, JV, or associate of the company. It is instead a subsidiary of its parent. This means that the treatment falls within all other investments treatment, being fair value through profit or loss within the accounts of sub 1. The amendments to IFRS 102 now include a new accounting policy choice, such that for investments in another group entity, the company can choose one of the following measurement policies, as long as it is applied to all investments within an individual class consistently. These options are cost less impairment, fair value through other comprehensive income, or at fair value through profit or loss. And the glossary to IFRS 102 includes a definition of group being a parent and all its subsidiaries. Therefore, sub 2 would meet the definition of a group entity in relation to sub 1, meaning that sub 1 now has an accounting policy choice to show its investments in sub 2 at cost less impairment within its accounts. It chooses to do so. So in addition to the amendments made throughout the body of IFRS 102, there have also been a number of amendments to the glossary that accompanies IFRS 102 and is an integral part of the standard. So a number of these amendments are minor tweaks, but some of the more useful amendments include expanding the definition of group reconstruction, which is used within Section 19 to determine whether merger accounting can be used or not, to include the transfer of the business of one group entity to another, or the transfer of the business of one group entity to a new entity that is not a group entity, but those equity holders are the same as those of the group's parent. There's also been the addition of some share-based payment-related definitions, such as those for performance condition, service condition, vesting condition, and vesting period. So now I'm going to take a look at IFRS and a reminder of the 2018 interim reporting disclosure requirements and effective IFRSs. So, as a reminder, with interim reporting season nearly upon us, the FRC has announced they will monitor companies' disclosures of the impact of the new financial reporting standards, IFRS 9, financial instruments, and IFRS 15, revenue from contracts with customers, in the interim accounts issued in 2018. The IAS 34, interim reporting, requires a company to describe the nature and effect of a change of accounting policy. The FRC stated that they expect quantitative disclosure to be accompanied by informative and detailed explanation of the changes, tailored to the company's specific circumstances and transactions. Any key judgments made by management in applying the new concepts and methodologies that were introduced by the new standards to be clearly explained, and an explanation of how the transition has been implemented after careful consideration of the transitional disclosure requirements under these new standards and the requirements of IAS 8. For some companies, such as those listed on AIM market, are not required to comply with IAS 34. However, a discussion of the nature and effect of a change in accounting policy is necessary for all companies in order to provide meaningful information to readers of their interim accounts. So in our March webinar, we discussed in more detail the points to consider for disclosure in relation to qualitative and quantitative information relevant to the company. I also want to remind you, don't forget that IFRS 16 and the IAS 830 expected impact of future standards disclosures should be considered within the June 2018 interims. These disclosures in relation to IFRS 9 and IFRS 15 were a source of disappointment to the FRC in December 2016 year-end, and they'll be focusing on whether these have been improved for IFRS 16. So IFRS 16 can be a labour-intensive exercise with significant amounts of data to be gathered in order to determine the accounting. And it's therefore key that this is not left until the end of the year, but that this exercise continues to be progressed if not already complete. There are also some specific amendments to IAS 34 that are consequential amendments upon the adoption of IFRS 15 I want to touch on. These specific IAS 34 amendments apply to periods in which IFRS 15 are applied and will therefore apply to June 2018 interims under IAS 34. These include paragraph 15b has been amended to also include recognition of a loss from the impairment of assets arising from contracts with customers in the list of events that require disclosure if significant, as shown by the underlined text in the slide. Paragraph 16a has also been amended to add the requirement, again as shown underlined in the slide here, to disclose the disaggregation of revenue from contracts with customers, as is required by certain paragraphs of IFRS 15 within the interim financials. These amendments must be applied when a company applies IFRS 15, so as I said, will apply for the June 18 interims. So, a lot of focus has rightly been given to IFRS 9 and 15, which are both effective for periods beginning on or after the 1st of January 2018. However, there are a number of other standards and amendments which also become effective from this date and therefore will be applied in the June 2018 interims, which I wanted to touch on. These amendments and clarifications include IFRS 22, which looks at foreign currency transactions, advanced consideration, amendments to IFRS 2, clarifying measurement of share-based payment transactions, amendments to IAS 40 around transfer to investment property, and some amendments to IAS 28, fair value or equity accounting for JVs and associates. We're now going to take a brief look in turn at what each of these clarifications and amendments cover. So, IFRS 22 was recently EU endorsed, so in April, and provides clarification on the treatment of advanced consideration which is received in a foreign currency. It provides guidance such that the date of transaction used when determining translation of these funds is the date at which they are received, and the deferred income, and therefore income itself, is not remeasured to reflect any exchange rate movements between that date of receipt and the date of recognition of the income. Entities can choose to apply the interpretation retrospectively for each period presented, prospectively to items in scope that are initially recognised on or after the beginning of the reporting period in which the interpretation is first applied, or prospectively from the beginning of a prior reporting period presented as comparative information. The amendments to IFRS 2 provide clarification on the accounting for the effects of vesting and non-vesting conditions on the measurement of cash-settled share-based payments. To clarify, you now would use the same approach as you do for equity-settled share-based payments. An exemption has been added in relation to specific share-based payment transactions with a net settlement feature for withholding tax obligations. And guidance has also now been added in relation to modifications to the terms and conditions of a share-based payment that change the classification of the transaction from cash-settled to equity-settled, such that on such modifications, the original liability recognised in respect of the cash-settled share-based payment is de-recognised, and the equity-settled share-based payment is recognised at modification date fair value to the extent services have been rendered up to that date. And any difference between the carrying amount of the liability at modification date and the amount recognised in equity at the same date will be recognised in profit and loss immediately. These amendments are to be applied prospectively, and retrospective application, however, is allowed if this is possible without the use of hindsight, but must be applied consistently to all changes. So IAS 40 requires a property to be transferred to or from investment property only when there is a change in use. This amendment clarifies that a change in management's intentions for the use of a property does not in isolation provide evidence of a change in use. An entity must, therefore, have taken observable actions to support such a change. IAS 40 now also gives some examples of appropriate sources of evidence, although it states this is not an exhaustive list. These examples include commencement of owner occupation or of development with a view to owner occupation for a transfer from investment property to owner-occupied property, commencement of development with a view to sale for a transfer from investment property to inventories, end of owner occupation for a transfer from owner-occupied property to investment property, and inception of an operating lease to another party for a transfer from inventories to investment property. Again, entity may apply the amendment retrospectively, but only if it's possible to do so without applying hindsight. And where the amendment is relevant to an entity, the entity should consider the transition rules carefully, as the requirements are specific and also include disclosure requirements if you apply it prospectively. Lastly, taking a look at IAS 28, which has been amended to clarify that a venture capital organisation or a mutual fund, unit trust and similar entities may choose, on an investment-by-investment basis, to account for its investments in joint ventures and associates at fair value or using the equity method. This amendment also makes it clear that the choice of method for each investment is to be made on initial recognition. This annual improvement must be applied retrospectively, and there is no transitional relief available for this one. Brian's now going to take us through a range of other news updates.
Thank you, Vanessa. Good afternoon. The topics I want to be looking at, or I'll be looking at, are changes to the AIM rules around corporate governance disclosure, the Quoted Companies Alliance Corporate Governance Code, which might be useful for AIM companies having to make those new disclosures, proposed revisions to the UK Corporate Governance Code issued by the FRC. A recent draft legislation has been issued and is expected to come onto the law books quite soon regarding narrative reporting by large companies. This could mean that unquoted companies will have to make corporate governance disclosures within their accounts. The government's review of the FRC and some FRC briefings on the back of CARILLION and also a recent hot topics briefing. So starting with the AIM companies, in our last webinar we highlighted that the London Stock Exchange had proposed changes for corporate governance reporting by AIM companies. In March, the LSC published these rule changes, which now require that AIM-listed companies comply or explain reasons for non-compliance against a recognised corporate governance code. These changes to the AIM rules mean that from the 28th of September this year, 2018, an AIM-listed company must include on its website details of a recognised corporate governance code that the board of directors of that company has decided to apply, how the company complies with that code, and where it departs from it, an explanation of the reasons for doing so. This information should be reviewed annually, and the website should include the date on which this information was last reviewed. Whilst the AIM rules themselves do not specify explicitly what a recognised corporate governance code is, AIM Notice 50, in which the rule change was announced, makes clear that there is some flexibility. It indicates that an AIM company should comply or explain against a code of corporate governance that is appropriate for a company admitted to a public market. And it includes examples of existing codes, such as the Quoted Companies Alliance's Corporate Governance Code and the Financial Reporting Council's UK Corporate Governance Code. It goes on to suggest that overseas companies with an AIM listing or companies with a second listing on an overseas market may consider it more appropriate to report using an appropriate standard from that foreign jurisdiction. Whilst the AIM rule change requires that this new information is included on the company's website, it should be noted that both the FRC code and the QCA code require some disclosure to be included in the annual report. This factor will be particularly relevant to companies publishing their financial statements on or after the effective date of this rule change. In response to the changes in the AIM rules regarding corporate governance, the QCA has released an updated code. The QCA Corporate Governance Code is a pragmatic and practical corporate governance tool which adopts a proportionate, principles-based approach, enhancing the user's ability to explain their application of the principles and their corporate governance arrangements. This may be particularly of interest to those small and mid-sized listed companies that are not subject to listing rules and who find the FRC's UK Corporate Governance Code unsuitable for their stage and size of development. The amended QCA code is designed around a set of 10 corporate governance principles that companies should follow, together with step-by-step guidance on how to effectively apply those principles. It also includes a set of prescribed disclosures and recommendations on whether these are best presented in the annual report or on the company's website. The QCA Corporate Governance Code and related materials, training and supporting material to aid implementation is available to QCA members, and the QCA Corporate Governance Code is also available to buy as a standalone product on a QCA website which is listed on the slide. As a reminder, in our March webinar we talked about the FRC's consultation on proposals for a revised UK Corporate Governance Code to reflect the changing business environment and help UK companies achieve the highest levels of governance. If finalised as proposed, the revised code will be shorter and sharper, with supporting principles being eliminated and a number of provisions being reduced. The proposals also feature some significant changes to the code structure. To compensate for this, the proposed revisions to the code are accompanied by proposed revised guidance on board effectiveness. The consultation closed on the 28th of February 2018, and the FRC aims to publish a final version of the code this summer, looking to be mid-July, to apply to accounting periods beginning on or after 1 January 2019. As we noted back in our November webinar, the government planned new legislation in relation to large private companies. Last week, this legislation, which has been developed as part of the government's corporate governance reform work, was laid before Parliament. The draft regulations, catchingly entitled the Companies (Miscellaneous Reporting) Regulations 2018, once they become law, will have a significant effect on the narrative reporting of large companies, both listed and unlisted. The new requirements will apply for periods beginning on or after 1 January 2019 and comprise 5 different disclosure requirements, each with a different scope. I'll now briefly look at each of these new requirements. Directors of UK companies have a duty to promote the success of their company for the benefit of the members as a whole, unless the company adopts a different purpose. And in doing so must have regard to the matter set out in Section 172 of the Companies Act 2006, including the interest of employees and the need to foster business relationships with suppliers and customers. This new Section 172 statement requirement applies to all large companies, as defined in the Companies Act, i.e. those which are not small or medium-sized, and applies irrespective of whether the company is a parent, subsidiary or standalone company, meaning that a group may feature several companies that fall within the scope of this new requirement. A company within the scope of the requirement must include a separate Section 172 statement in its strategic report that describes how the directors have had regard to their duties as set out in Section 172 of the Companies Act and makes reference to key decisions and strategies that have affected the financial year. All companies that are not quoted companies must also put their Section 172 statement on their website. Quoted companies are already required by the Act to publish accounts and reports, which would include this statement, on their website. The new requirement is intended to encourage directors to think more carefully about how they are taking account of the Section 172 matters. Another disclosure requirement relates to engagement within employees. This requirement applies to all large and medium-sized companies with more than 250 employees on average in the year. If the company is a parent, the average number refers to the number of employees in the group. No regard is to be had in either case to a person employed to work wholly or mainly outside the UK. So we're talking about UK employees hitting 250 on average. The company within its scope must summarise how the directors have engaged with employees in the period and how they have had regard to employee interests during the year. The disclosure must also refer to the effect of that regard on the principal decisions taken by the company during the year. Similarly, there's a requirement to make disclosure about engagement with suppliers, customers and others in a business relationship with the company. This requirement applies to all large companies, like the Section 172 disclosures. It's not tied into numbers of employees specifically. A company within its scope must include in its director's report a statement summarising how the directors have had regard to the need to foster the company's business relationships with suppliers, customers and others. Again, the disclosure needs to include reference to the effect of that regard on principal decisions taken by the company during the year. There's a new requirement to make a statement of corporate governance arrangements. This requirement applies to most companies with either or both more than 2,000 employees or a turnover of more than 200 million and a balance sheet total of more than 2 billion. As with the Section 172 statement, this requirement applies irrespective of whether the company is a parent, subsidiary or standalone company. The directors' reports for companies within the scope of this requirement must include a statement of corporate governance arrangements, which gives information on which corporate governance code, if any, has been adopted, and the company's application of that code, and details and reasons for any departure. If the code has not been adopted, it must explain the reasons for not adopting a corporate governance code, together with what arrangements for corporate governance were in place for that year. As with the Section 172 statement, this statement of corporate governance arrangements must be published on the company website. For quoted companies who are required to issue a statutory director's remuneration report, there's a new requirement to make disclosure of pay ratio information. A company within the scope of this requirement must include ratios comparing the CEO's pay to the 25th, 50th and 75th percentile pay level of employees. To start with, it's just for 1 year, but over time it will build up to a 10-year record of pay ratios. There is also a requirement for an explanation for any changes in the ratio from year to year, but this requirement for change in ratio is only required when a company has more than 250 UK employees on average in the year. If the company is a parent, the pay ratio information and the UK employee numbers should relate to the group. In addition, all quoted companies will need to report on the impact of share price growth on share-based executive pay. The intention is to give shareholders greater understanding of how significant share price growth over an executive pay performance period can push up executive pay, and to encourage remuneration committees to consider, if appropriate, whether any discretion should be exercised to avoid mechanistic pay outcomes. In addition to the draft regulations, the government has also published a useful frequently asked questions document to help companies get to grips with these new requirements. And we'll be sending a link to that document in the email that goes out after this talk. Coupled with the requirement for private companies to make disclosure, or large private companies to make disclosure about corporate governance, the WATES corporate governance principles have been published in currently a draft form, the consultation period closing on the 7th of September 2018. The WATES code is a voluntary governance code that has been designed with private companies in mind and is intended to be the key code for companies within the scope of the statement of corporate governance arrangements that I just mentioned. As private companies have no reliance on the public equity markets to raise capital, the focus on shareholder protection and communication is a less important aspect of corporate governance. In general, shareholdings are held by a smaller group of more involved investors. The objectives and actions of the company may be more heavily influenced by the needs of those individuals. In consequence, the WATES code focuses more on wider stakeholder needs. The WATES code has been drafted on an apply or explain basis, meaning that companies adopting it must seek to apply all of the 6 high-level principles and explain how they have done so. In this respect, it is more like the QCA code than the IFRS's UK Corporate Governance Code. The latter has a series of more detailed provisions that a company must comply with or explain the reasons for non-compliance. The WATES code comprises 6 principles. The purpose of the company, dealing with the values, strategy and culture of the business. The composition of the board, dealing with effective board composition. Responsibilities of the board, covering accountability in terms of reference at board level. Oversight of opportunity and risk facing the company, focusing on the long-term success of the company. Remuneration, dealing with executive remuneration structures and how it's linked to long-term success and paying conditions elsewhere in the company. And stakeholder engagement, encouraging meaningful engagement with employees and other stakeholders. So moving on from those corporate governance matters, the government has announced a wide-ranging independent root and branch review of the Financial Reporting Council, the FRC. In setting the terms of reference for the review, the government explains the FRC's remit has developed considerably since it was initially established, and in addition, since its last review in 2011-2012, there have been changes in the expectations placed on regulators and how they operate, and the regulatory environment in which they exist. The review has 2 overarching objectives: to put the FRC in a position to stand as a beacon for the best in governance, transparency and independence, strengthening its position and reputation, and to ensure that the FRC's structure, culture and processes, oversight, accountability and powers, and its impact, resources and capacity are fit for the future. The root and branch review is due for completion by the end of 2018 and will be headed by Sir John Kingman, Chairman of Legal and General PLC. It will include engagement with significant stakeholder groups, including those involved in preparing financial accounts, the users of those accounts, and those affected by other aspects of the FRC's work. Finally, to touch on a couple of FRC briefings issued this year. Firstly, one issued in January 18, reminding boards and companies of their reporting obligations addressing the role of the Audit Committee. It's aimed specifically at companies operating in the construction and business support service sector, but its message will be relevant to many companies. The alert also highlights that the accounts must give a true and fair view of the assets, liabilities, financial position and profit loss, and that the analysis presented in the strategic report must be fair, balanced and comprehensive. These requirements, the FRC notes, require careful consideration of the content and clarity of the disclosures provided. The alert goes on to highlight some specific areas of the annual report and accounts that are particularly relevant following recent events. Most matters covered have been raised by the FRC in previous publications, such as their annual review of corporate reporting and as part of the thematic review programme. We recommend that you read the 6-page news alert in its entirety, particularly if you operate in one of the FRC's 2018-19 priority sectors, which includes construction and business support, but includes a number of others which I'll touch on in a minute. Key messages relate to going concern, the decision that the going concern basis of accounting is appropriate, that no material uncertainties exist, may require the application of significant judgment. The board should consider carefully whether further disclosure is needed to meet the requirements relating to significant accounting judgments. Strategic report, risk and viability reporting. Section 71172, which ties into this, requires the company to have regard to the interest of stakeholders. Stakeholders includes employees, and proper consideration should be given to their interests, including employees and former employees' interests relating to companies' pension schemes. The strategic report of a quoted company includes a description of the business model, and this may well require an explanation of the factors that are most important to the outcome of key contracts, therefore the continued success of the company. Judgments and estimates. As the FRC's recent thematic review on judgments and estimates sets out, there should be clear expectations on the disclosures required. There are situations where management may need to quantify the key assumptions underlying those estimates in order for users to understand the company's position and performance and to facilitate intercompany comparison. Cash flow net debt indicators. As noted in the FRC's October 2017 letter to Audit Committee chairs and finance directors, clear information on the levels of debt, cash flows and conversion, including the process of conversion such as invoice discounting and reverse factoring, is important. And finally on this topic, complex employee pension arrangements. The FRC's recent thematic review on pension disclosures highlights the importance of the disclosure requirements of IAS 19 and the need to explain in the strategic report any principal risks and uncertainties identified with respect to pension obligations. The briefing also highlights the role of the Audit Committee in areas such as communication of the work it has carried out in respect of significant financial reporting risks and judgments made, robustly challenging accounting policies, judgments and estimates, principal risks and uncertainties, management's assessment of going concern, and whether any material uncertainties exist which need to be disclosed. And then finally, only last week, the Financial Reporting Council issued a briefing setting out the current hot topics of its corporate reporting review function, also known as the FRRP. These topics will be particularly relevant to companies soon to prepare interim accounts. We've already mentioned the effect of IFRS 9 and 15 on interims and the associated disclosures. The briefing also addresses some other topical issues. For example, it notes that the transparency of supplier finance arrangements will be an area of specific FRC focus during 2018. Also that it will pay particular attention to the impairment disclosures of companies in its priority sectors, financial services, oil and gas, general retailers and business support services, as well as market sectors where there has been a number of profit warnings and asset write-downs. Finally, the FRC highlights 4 areas identified by recent monitoring activities. Firstly, it reminds preparers and auditors that when considering whether a matter is material, regard must be had to the amounts determined in accordance with IFRS, not just management alternative performance measures. Secondly, the FRC expresses concern that it is continuing to identify companies that classify cash flows incorrectly between operating, investing or financing activities. Thirdly, the FRC has identified companies that have failed to restate prior year EPS disclosures following a share split or consolidation. And finally, the FRC has identified some potential breaches of the Companies Act requirements for the payment of dividends resulting from a failure to file interim accounts with the registrar before paying a dividend in excess of the distributable profits shown in the relevant accounts, which are usually the company's most recent audited accounts.